Hi everybody, Thomas Moore here at Rebel Income. In the technology sector, dividend-paying stocks are the exception rather than the rule. Besides my natural inclination to all things tech, that's a big reason why dividend-paying tech stocks appeal to me more than a lot of the most talked about big tech names. One of the 600-pound gorillas of the tech sector is Intel. Over the last few years, Intel is a name that has lost a lot of its luster. Management overconfidence, for one thing, opened the door for smaller competitors to out-innovate Intel in areas of its core business, including PCs, servers, and data centers. The result was that these companies managed to seize market share from Intel, forcing a CEO change in 2021 and prompting the company to engage in a multi-year transformation designed to reinvigorate their core specialties and to build a new business segment with Intel Foundry Services. This new segment aims to localize foundry and fabrication production within the United States. This is an area that had previously been concentrated in Asia. Foundry Services represents a massive, high-margin opportunity that nonetheless requires years of intensive capital investment that isn't expected to begin to reap real dividends until 2025. From a pre-pandemic high at around $69 in 2020, Intel stock dropped into a long-term downward trend that finally found bottom in the beginning of 2023 at around $24 per share. With a year-long recovery since that point to its current price at around $43, the latest question could be whether the company is ready to start turning the corner. Maybe it's even on the cusp of recovering some of its former glory. If so, what does that mean about the stock's current price? Is it a good bargain right now? Let's try to find out. Before we dive into the details, I want to take a minute to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades I publish for my Rebel Income trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions and current market conditions. You'll find the link in the description area of this video. Take a look. I know you'll find something you'll be able to use in your own trades. Intel's upward trend is pretty easy to see. From that low at around $24, possibly $25 in February of 2023 to its peak most recently at around $52 in December of last year, the stock followed an impressive upward trend for most of the year. From that point, however, momentum has shifted back against the stock with a lot of selling activity that has pushed the stock down to its current level in the neighborhood of $43 per share. A big chunk of that drop came immediately after the company's latest earnings report, when it fell from just about $50 overnight to about $44. More recently, however, the stock does appear to have found a support level at around 42, with immediate resistance expected somewhere around the midpoint of the gap that we saw at the end of January. That falls in line with some pivot low activity at about $46 per share. Now, if the stock does fall below $42, it breaks that current support level. The next question is, how far could it drop? And it looks like it is most likely to find next support at around the $39 range based on a pivot high in August of last year. If the stock can push above $46, then it does look like it should have upside back to that December peak at around $50 per share. And with all of that in mind, we can start to think about what the stock looks like in terms of near-term opportunity versus risk. From the stock's current price at around $43, looks like there's about $3 of upside to immediate resistance, with about $1 down to current support. So that's $1 of downside, which is a very near-term reward to risk ratio, about 3 to 1, which is interesting. However, if the stock drops below 42, it does look like it's got about $3 of downside. So that makes this $42 support level very important right now. If we think about reward to risk in a longer time frame, I'll call it an intermediate time frame, then from the stock's price at about $43 per share, if the overall upward trend holds and extends itself, then we should have about $8 of upside against possible downside from about $43 down to 39. So that's about $4 of downside. Reward to risk is not quite as high in that case, but it is sitting at about 2 to 1. So if you're looking for a short-term trade, that could be pretty interesting. With all of that in mind, one of the big questions that we need to answer is whether or not the company's overall fundamentals are strong enough to support the idea that the stock should continue this upward trend, or is the gap that occurred after the latest earnings report an indication that maybe there's more downside here than one might expect? Let's go ahead and dive into the fundamentals. Intel's free cash flow has been following a clearly negative pattern for the past year. In the last quarter, free cash flow was negative $14.2 billion. That is an improvement over the last 12 months from $19.9 billion. However, we do see that it also dropped from the prior quarter when it was just a little bit over negative $10 billion. Negative free cash flow is a major concern. However, improvement in those numbers, even if they remain negative from one quarter to the next, can signify a reversal of overall fortunes that should hopefully lead to a turn to positive free cash flow. Right now, it looks like that is still up in the air. As I mentioned earlier, it's expected that capital expenditures related to the development and establishment of Intel's foundry services will continue into 2025. That means that the real results and profits from those services are going to come on a gradual basis. Intel has begun to win new customers in this area, but this is going to continue to be a segment that is going to be a smaller portion of their overall business until that build out is completed. Until then, we can expect free cash flow is going to remain challenged. Even with the reality of negative free cash flows I've just described, the company has very good liquidity with a little over $25 billion in cash and liquid assets. Now, that has dropped over the last year from about $27.5 billion, but it has also remained fairly stable over the last 3 quarters, and that is generally a positive sign. At the same time, long-term debt sits at just a little bit under $47 billion. The positive about long-term debt here is that it has declined from about $48.8 billion a year ago. One of the counters to the negative free cash flow picture that we've just talked about comes from the company's operating profile as reflected by net income versus revenues. Over the last 12 months, net income was 3.11% of revenues. That improved in the most recent quarter to 17.32%. That's a significant improvement and indicates an expansion of overall profitability that counters the negative free cash flow picture. It implies that Intel may be on firmer ground than many expect, even with the fact that capital expenditures for those foundry services are going to continue for at least the next year or so. Intel is one of the first companies in the tech sector to begin paying a dividend years ago. And as of last year, it was sitting at an interesting level of roughly about 3%. However, in the middle of 2023, the company cut the dividend in an effort to preserve cash from about $1.50 per share to its current level at 50 cents per share per year. That equates to a very modest dividend yield of 1.17%. For me, the more important part of this picture is that the company is still paying a dividend. Even though they cut it, they didn't eliminate it altogether. Even with all of these elements in place, however, it is pretty clear that the company does not offer a practical value proposition right now. My value analysis puts a fair value price for the stock a little bit below $40 per share, and that's about 7% below the stock's current price. I do think that if the stock does drop below its current price, there is a very interesting value price to be had at around $32 per share. So takeaway is that for now, from a technical standpoint, Intel could be offering an interesting bullish opportunity. However, from a long-term value-based perspective, Intel just isn't a great buy right now. Thanks everybody. I hope this has been useful. If you like my content, please do go ahead and click here to subscribe to my channel. You can also get an example of the kind of videos I publish on this channel by clicking on the video shown right here. Thanks again. I'm Thomas at Rebel Income. Talk to you again soon.